Thank you for joining us, everybody. I'm Sonali Basak. I'm a financial reporter here at Bloomberg News. And with me, I have three guests to speak about their engagement with corporations and very many issues that the pension system faces when it comes to climate change. So with me today, I have Adam Matthews, the Director of Ethics and Engagement at the Church of England. I have Bertrand, Millot, who's the Vice President of Risk Management, Fixed Income, and Head of Climate Risk at CDPQ, and Simpson, the Interim Managing Investment Director and Board Governance and Sustainability at CalPERS. So we have representation from around the world. Thank you all for joining us today. The place I'd like to start with is corporate engagement, just because so many of you have done so much in such a short amount of time to directly engage with corporations around the world. And maybe you can get us started here about, in the past year, some of the biggest strides you've taken.
Well, thank you very much. It's lovely to be here at this event with Adam and Bertrand. CalPERS works very closely with other funds, and the Church of England and CDPQ are two of our closest allies. The most important, I think, initiative this year for us has been the growth of Climate Action 100 Plus. And this is an initiative that CalPERS co-founded just a few years ago to address the systemic risk of climate change. When we say systemic, we mean something you can't diversify out of, and which could have a knock-on effect across sectors and impact in the portfolio. So just yesterday, we announced that the assets under management by signatories to Climate Action 100 Plus has just gone over the $50 trillion mark. And the companies that we're engaging collectively are responsible for the third source of emissions on the planet. So the biggest source is China. The second source is the United States. And number three, if they were a country, would be these 100 companies. So we're taking on the very biggest, the systemically important carbon emitters. And the way that we're doing it is by having this shared ambition with our fellow investors. We're also seeing a lot of work on issues on human capital management. I think, of the 2,000 or so companies that CalPERS engages every year, we, this season, ended up voting against the reappointment of 900 directors on company boards that lack diversity, number one, so they're missing out on a huge pool of talent. And number two, the engagement was not fruitful. We weren't making progress. So I think, engagement for a big pension fund like CalPERS, it's very much the Teddy Roosevelt advice. You speak softly, but you carry a big stick. And the stick that you have is your ownership and the voting rights and stewardship that come with being an equity owner.
I'd love for Adam to also weigh in on this, because just over a year ago, we had this great story written by our colleagues at Business Week about your engagement through Climate 100 with Royal Dutch Shell, even though the Church of England was a smaller investor in the company. And so can you speak to us about how you work with a range of investors to influence such changes?
Absolutely. I mean, it goes to the heart of the matter. Look, however big you are, whether you're $1 trillion, 7 trillion, or 3 billion, none of us are big enough to influence the change that needs to happen at a systemic level in the time that we've got left. So therefore, coming together with like-minded pension funds with very clear asks, which CalPERS convened through Climate Action 100 and all the global investor networks, gave an opportunity for 500 funds to very clearly articulate their expectations of companies to align to the goals that society has set in the Paris Climate Agreement. And there we want to see net zero commitments, and we want to see business plans and lobbying that align to that. And so the engagement with Shell really has been on behalf of that 500 group of investors, now over $50 trillion, which is a huge percentage of their shareholder base. And it's been a very deep, detailed dialogue and discussion with Shell over the years. And I lead with a fund manager, Robeco, in Europe, and we have a much larger group of funds sitting behind us as well that are involved in dialogues. But on a weekly basis, we're in touch with the company 3-4 times a week. We're regularly talking with the board, we're talking with the CEO, we're talking with the lead directors. We want to see the core commitment which Shell made, that they're going to take responsibility for their Scope 3 emissions, which is about 80% of their impact. We then wanted to see that translated into short and medium term targets, which we achieved. We then want to see that connected to their executive pay, which we achieved. And equally, we wanted to see that translated through to the way that they lobby, which they equally committed to. And now we're in a really detailed discussion, because at one level, you've got that sort of assurance. So they're on the same page, they're facing to the same goal of society's target of Paris. And now we're working with the company. How do we put in place the transition plan? What does that mean for you as a business in Shell? How do you align capital expenditure? And equally, what are the levers you as a company can pull that are in your control, but what are the ones that aren't in your control that you can influence, but you don't determine? And there's a common agenda between us as a CA100 company investor, them as a company determined to commit to achieve net zero, working together to really drive the transition through a lot of their customers, through the demand side in the auto sector, shipping, aviation, that ultimately is going to determine whether a company like Shell transitions. So we're now into the detail, we're into the really complicated phase of engagement, and the opportunity really is for a company like Shell to transition with the support of their shareholder base, and that enables me as a pension fund to remain invested in them, and for that company to succeed, and our pension funds to have their pensions paid for down the line.
I'd love to get the perspective of CDPQ on this as well, but also persuading companies to change must also meet some resistance. What are the challenges that you face when you're engaging with companies?
Well, thank you. I think you need to have a realistic dialogue. Not all companies are the same. Not all companies operate in the same industry. Some of them, especially in the power sector, for example, are regulated. So there is stakeholders, government stakeholders need to be taken into account. You need to take these realities into consideration when you interact with these companies and be so that they listen to you. If you apply across a broad brush approach across the board, then it's going to be difficult to be relevant to that specific company. So you need to be quite educated and take into account those circumstances. This is where science with regards to climate change can be helpful also, because the trajectories for decarbonization of various sectors are dependent on those sectors. So one needs to be intelligent about these things and be selective. It is, it's very, very important. Engagement is very, very, very important. I can't stress that enough. It is a lever that we as investors and long-term asset owners have to change the companies, to make the companies that we invest in change, whether it's climate change, whether it's diversity, whether it's other issues, governance, etc. Those aspects are very important. And we, as Anne said, we have the levers, we have the stick. There is a lot of talk in the investment industry about greening portfolios by divestment. To us, that is an abdication of our responsibilities, because it doesn't change anything to the planet. It just offloads the thing from our book to somebody else's book. And we think we have a much more important role to play by actually pushing companies to do the right thing. And that is within their activities, but also what they buy, how they market themselves.
So this seems to be a conversation that's quickly advancing across the world. But of course, here we are with a huge problem across the world. Do each of you believe that change is happening fast enough? Anne?
Absolutely not. When we think about the planning that's going on for COP26, you don't know whether to laugh or cry that it's taken 26 years to get to the point where we're really digging in on climate change issues. So on that, no, but the point now is the urgency is evident. And the other thing I think it's important to remember is that investors have a hugely important role in the climate change transition. But the progress will only be made if we have the accompanying policy and regulatory pieces in place. So for example, for CalPERS, we think there's an urgent need for carbon pricing. There's the great externality of causing global warming currently gets a free ride in the economy. And yet all the time, effort, money, impact on not just investors, but workers and communities, all that, getting that right means we need a policy framework. Mandatory risk reporting, I think there's good progress being made on that. But right now, investors understand these huge risks and the opportunities. And yet we are working from almost improvised data, even though we've got some very good frameworks like TCFD, which we support fully. So there is a need, if we're really going to drive this forward on the financial side, we've got to have mandatory climate risk reporting integrated into the financials. That's number one. Number two, we've got to get the economics priced. So we need carbon pricing, we need the removal of subsidies for fossil fuel. So it's this coordinated approach that will enable us to pick up the pace. Because if we're talking about net zero by 2050, we have got no time to hang about at all. I think the important thing about Climate Action 100 Plus, as Adam was saying, is that we are now at a stage of very detailed discussions and time-bound transition actions that are being taken by companies. So we have just launched for consultation with signatories a benchmark which will track what companies are doing on short, medium, and long-term timeframes on a whole range of very specific issues that include the items that Bertrand and Adam have mentioned, but also CapEx. And we also have a placeholder in this benchmark for the notion of the just transition, which was set out in compelling detail in the preamble to the Paris Agreement. And we all know that the transition has to be managed in a way that protects the most vulnerable, but we're not yet there with the business community stepping forward with plans that can lay claim to this being a just transition.
Now, you kind of front ran me on a question here that I think is one of the most important, as the U.S. is about to face a new presidential administration where green initiatives are very high up on the agenda. I think there's something that we can learn about the needs of the world as well here. Adam, maybe you can address here what you think Greater Europe needs to be doing to address this problem on a regulatory perspective to be able to make your job easier.
Well, look, it's a partnership. It's a partnership with governments. It's a partnership with the finance sector. It's a partnership with companies. And those that commit to the long-term goals of Paris, those that are committed as a pension fund, as a company, as governments to net zero, and then translating that into targets in shorter, medium-term timeframes, you're all pointing in one direction. And now the key thing really is, how do you then ensure that you've got the enabling regulatory change that can mean that we can go faster, that means that we can bring more finance to play, to share the risk, to play our role in driving that transition. So I think the opportunity with the incoming Biden administration, working together with Europe that's committed to net zero and looking to use its stimulus post-COVID to really sort of energize the transition, looking at new ways in which you can utilize hydrogen, economy, etc. I think these are opportunities, but also not to forget, you've now had Japan, you've now had South Korea, you've now had China also commit to net zero. So there is a real ramping up of government commitments. It's got to be converted into that short-term set of measures that really, in particular, how we're using the stimulus packages to ensure that we're incentivizing transition. And a fund like ours, I mean, we have a large element of our funds invested passively. And for us, it's really important. We don't think being passive means that you're passive in your responsibilities. And we've been able to embed the insights of Climate Action 100 and Transition Pathway Initiative into an index that double weights. So we double our investments in companies that are committed to net zeros to reward them, to incentivize. And I think we can also do a lot more in the finance sector. But one other area that's absolutely critical that Climate Action addresses is that relationship with public policy lobbying that companies undertake. And we're looking very closely at how they resource trade and industry associations and the lobbying they do of governments, of the regulatory systems, of parliaments, of legislatures, because there they need to do that consistently with their commitments. And there we are really wanting to see evidence that there's good practice, because ultimately, as I say, it's a partnership and the opportunities for us to lobby together for the right regulatory change that aligns us to achieve in Paris.
This question also applies to CDPQ as well, and wondering what the role of Canada is in this discussion here too.
Well, I will just reinforce what Adam and CalPERS and were saying, but maybe I'll address the question and the way we look at this, which is there is the side of clean tech, but there is also financing the transition. And we're pension plans. We have a fiduciary responsibility. We are relatively conservative because people, our beneficiaries, expect to see pensions at some point in the future. And so the way we've addressed that question is to create some small funds to invest in research in green tech, and we're partnered with family offices. We do a little bit of venture as well, but only a little bit, because we need to remain on the low risk side of investments. However, we are a very large active investor. And so when it comes to transition, we've been financing renewables. We're one of the largest shareholder of a very large power, green power company in the US. We have increased our green investments by almost doubled actually in 2 years. We've set targets. And so we, in summary, or using an image, we're not so much invested in developing the latest battery technology, but we're certainly invested in financing utilities with billions of dollars to install batteries, to install green power, to install solar power, so that that transition happen. We have a lot of capital, and therefore we tend to invest it in places where that capital-intensive industries at the time when these things are being deployed.
Now, I'm really glad you brought this up also, because we're also getting a question from our audience. From Katie in San Francisco is asking Anne particularly, how is CalPERS looking to invest in the new wave of clean tech companies?
Well, it's not such a new wave. CalPERS actually invested, before I came to CalPERS had quite a big clean tech portfolio, and we lost hundreds of millions of dollars. And I think it was a good example of moving too soon, moving early. Where we are now, if you look at our own TCFD report, there's CalPERS investment strategy on climate change. It came out in July. You'll see a lot of detail about what we're doing in each asset class. So clean tech is obviously a very broad category. But in private markets, we have almost 20% of our assets are in what sometimes is dubbed climate solutions. So that's renewable energy, water storage, energy efficiency, as specific investments, and sustainably certified buildings. Which is also very important, because you have to sort of look at all of your asset base and see where emissions are coming from and where the opportunities are. So we don't, as Bertrand said, we have not at the moment got venture capital exposure, largely because I think we're so big. I don't think we do a very good job in markets where you need to be very nimble and very flexible. But certainly in our private asset classes, this is turning into quite a big opportunity set for us. Then, again, echoing Adam and Bertrand here, the real action on the take-up of technology is going to be in the companies that need to adopt, integrate, invest in the technology that's going to bring their emissions down. So I think right now there's a huge amount of technology that is ready for deployment. The innovative end, the venture capital end, the life sciences projects at universities. This is all a wonderful part of the financial ecosystem, but it's not something that we are very well suited. And we don't have financially, we don't have a good track record. in that area.
Is it an area also that you are looking at over at the Church of England, Adam?
Yeah, the pensions board, obviously we invest across multiple asset classes, and we absolutely look for opportunities to align our investments to supporting the transition. And that is a key part of the role of many of our managers. We are increasingly going into private markets, and we see real opportunities there to be at the sort of forefront of supporting those new businesses that are going to be part of the solution. But equally, just through the way that we've managed to establish the passive index, the FTSE TPI Climate Transition Index, there we've seen a 36% increase in green revenues that we're now exposed to in the past year from putting $1 billion in that fund. So we are finding different ways in different asset classes, be it infrastructure, property, private markets, where you can look for those opportunities to support the transition as part of a strategy to mitigate the risks that we as a fund are facing in the transition, and to benefit from the opportunities, all in the interests of serving our beneficiaries and the world that they're going to retire into that isn't hopefully going to be ravaged by the extremes of climate change. So I think it's hugely important that funds look for those opportunities, both on the positive as well as sort of managing those risks.
We have another question from the audience, and I think we only have time for one of our panelists to answer it. So I'm opening it up to you. What do you think about the evolution of carbon markets, both compliance of cap and trade credits as well as voluntary offsets?
I may. I think they are a great tool to price carbon markets. It's a necessary thing. Policy, as was mentioned by Adam and Anne earlier, is also very important. Carbon pricing by governments, but cap and trade is a great system. Again, governments need to make sure that they reduce the amount that is available for trading, i.e. tighten the cap. With regards to, so it's a great tool for the transition. With regards to offsets, one needs to be very, very careful about the quality of these things. There is a lot going on. Some are regulated, some are not. So the ones that are not so good are basically not worth the paper they're written on. So one needs to be very, very careful about these things, but it's also useful. But in the end, one must think that we need to go to a world where, there is zero carbon. So I mentioned a transition. It's good to go from now to maybe 2030, 2035, 2040. But at some point, there should be nothing to trade, hopefully, if we get there in 2050.
Last question also to throw out as well. I know, Adam, you had mentioned divestiture often doesn't make sense to you. And it's a huge topic. I know it's something that pension beneficiaries fight for a lot. Are there instances in which divestiture does make more sense to you?
Well, look, it's about how you assess the risks that you have within your portfolio. Ultimately, you want to see as many companies set themselves on a pathway to the transition. We will make judgments in terms of which companies we think have got credible plans. There's now tools available to investors to determine that. The work that Anne's referred to on the Climate Action 100 has a benchmark that really will test whether companies have proper transition plans. And that enables us then to assess whether those companies are ones that are likely to manage the transition, have the capabilities, have the strategies in place, and those that aren't. And then it's for funds to make decisions as to what's appropriate to their own approaches in investment. We as a fund do make disinvestments. And I think the thing that we try to create with our passive fund is that ultimately, if you've got the plans, if you've got the disclosures, if you're making the commitments and you're properly evidencing it, and that's independently verified, then we're willing to double our investments in you. So there's a real positive here. The door's not closed to anyone, but there are companies that are refusing or resisting, and actually you do sometimes have to draw a line, and we as a fund do. But ultimately, let's get as many companies on the right path, working with us in the common interest of achieving the goals of the Paris Agreement and ensuring that they succeed, our pension funds succeed, and the climate is addressed in a way that means that everyone has a world to retire into that doesn't have climate emergency events all the time.
And do you believe investors in the US will be quicker to divest?
Well, divestment is a problem because all you do is sell your shares to someone else. So if your objective is to manage your risk and you dispose of the asset, that's fine. That's just part of the normal investment process. On climate change, the problem is if we walk away and hand over our shares to someone else, the company's off the hook. and we are still exposed to the risks of those emissions going up into the atmosphere. So this issue about divestment as a solution, it might be a solution for making your portfolio be de-risked in certain ways, which is, I think, Adam's strategy. But also, you're not managing the risk of those emissions. And bringing those emissions down is the real goal.
One of the key ways we could do that is through bonds. I think there's a great deal of work for us all to do in relation to the finance in bonds.
Yes.
Denying the debt, engage in your equity.